Federal Reserve Chairman Ben Bernanke back on Capitol Hill today, day 2 of his semi-annual testimony in front of Congress. Yesterday, he told the Senate Banking Committee that rising oil prices are a temporary threat to growth, but probably won't cause a permanent increase in inflation. Today he's going to be in front of the House. With a little bit more on what this means for the direction of rates, what it means for your bond investments, we turn to Jim O'Sullivan. He's here with us this morning as chief economist at MF Global. We crunch the numbers, and Jim is one of the most accurate bond forecasters in the business. Pleased to have him back on the program with us this morning. Jim, always good to see you. Before we talk bonds, I want to ask you what all of the violence in the Middle East is doing to companies, is doing to growth in the U.S. I mean, when the Greece headlines hit the skids, right, we saw a lot of pullback, and it did affect growth.
Well, frankly, it's too early to say. I mean, certainly the manufacturing ISM number yesterday, which probably covered more or less the first 2 or 3 weeks of February, compared with January, showed booming growth. We're probably going to get the same from the non-manufacturing ISM index tomorrow. We expect to see a pretty strong employment report on Friday. So in general, momentum looked very good before this turmoil. So time will tell over the next few months how much fallout there is. Using the stock market as a barometer, so far the S&P 500 is down less than 3% from the peak. Now you compare that with a year ago, and ultimately the S&P 500 fell 16% from late April through early July. So I would say so far what we've seen is not a big threat, but obviously there's a lot of uncertainty here.
So speaking of this uncertainty, one place it certainly is showing up, as you mentioned, not so much in stocks, but if you look at the oil price, we're back at $100 a barrel. We know it takes, what, 120, 130 per barrel to really meaningfully slow growth, but I mean, I have to assume there's a psychological effect in there somewhere, right? If people are watching these prices, they have to hold back on what they're spending.
Well, the trend in oil prices, of course, had already picked up because of stronger growth over the past year or so, globally as well as in the U.S. And the trend was up to $80 to $90 a barrel a month ago. And now we've risen another $10 to $20 a barrel, depending on what series you look at. In terms of rules of thumb, I would say every $10 of an increase, whatever about the exact level, is worth about 0.2 on GDP growth over the following year. So we've seen a little bit of an increase. It's not enough to affect growth significantly. But, I mean, that said, I would quickly throw the caveat that when you look back at previous oil crises, such as the 2 in the 1970s, or even when Iraq invaded Kuwait in 1990, it wasn't just the oil price impact per se. It was more broadly the factors that were driving oil prices higher were generally affecting business and consumer confidence. There was a tendency in those episodes for long-term inflation expectations and interest rates to rise. And again, so far at least, we haven't seen much of a hit to the stock market. So far at least, we haven't seen much of a rise in long-term interest rates. In fact, if anything, the opposite in the last couple of weeks. But again, this is an evolving situation.
How much do you think that Bernanke is going to be pressed today? I mean, we did see him pressed on this question yesterday by the senators.
Well, it's something which he doesn't have an absolute answer for, in the sense that he's saying on the one side it's a negative for growth. On the other side, it is a plus for headline inflation, at least in the near term. And of course, it raises the question, to what extent will that seep into the long-term trend and the core numbers? And he's very much
parsing his language yesterday on this point, right?
And he's very much of the view that it's a near-term boost to the headline inflation numbers, but the commodity content, the oil content of most goods and services is pretty small. Inflation expectations are still pretty tame. So the boost to inflation ends up being temporary. But again, he made clear that this is something,
kind of cold, hungry inflation, right?
This is something that he's watching. I mean, it's absolutely something he's watching. But so far, I would say, if anything, he's putting a little more emphasis on the potential threat to growth than the boost to the trend in inflation, which, if anything, means this turmoil means it's less likely he's going to tighten quickly rather than more likely.
Speaking of growth, we know we have this huge employment report. This is a focal point for economists, for investors. How are we going to know if we see a little bit of a snapback from January's numbers? What's going to be compelling to you?
Well, of course, to some extent, the number is going to be boosted by a payback for weather effects in January, so it's not going to be the final word. We expect a 200,000 increase, which is not all that different from consensus at this point. Certainly less than that would be disappointing. We'll see what the details show in terms of weather effects when you look at some of the details in the household survey, which give an indication of how much there was by way of weather effects. We'll see what revisions were. That's been a big story in recent months. Every month we get the payroll number. There are these routine upward revisions to the prior 2 months. We'll see if unemployment held on to most of its big drop. So there are a lot of details there. But also I would keep a close eye on the non-manufacturing ISM survey tomorrow. That's been a very important indicator.
And last word, best place to be if you're in the bond market?
Well, I think ultimately rates are going going higher over the next year. I don't think they're shooting up because inflation is still pretty tame. Personally, I think risk assets are more the place to be. I think the equity market is a better place than the bond market myself right now.
So, all right, bonds have had their day. Jim O'Sullivan, thanks very much. Jim O'Sullivan joining us right here in the newsroom. He's the chief economist at MF Global. He is a Bloomberg best forecaster on interest rates. And you just heard him said if you're betting on a direction, they're going higher. So maybe stocks are worth more of a look than bonds.